Listen, I'm going to be very direct with you because at this point in our lives, neither of us has time for nonsense. You're making a mistake with your portfolio right now, and it's not the mistake you think. It's not about picking the wrong stock. It's not about bad timing on a trade. It's something far more insidious, and I've watched it destroy more retirement portfolios than any market crash ever could. I've been investing for over 40 years. I've navigated the crash of 1987, the dot-com collapse, the 2008 financial crisis, and everything in between. And I can tell you without hesitation that the single biggest threat to your retirement isn't the economy, isn't inflation, and isn't the Federal Reserve. It's you, more specifically, it's your emotions. And if you don't get this under control, everything you've spent 40 years building could evaporate in a single moment of panic. Before I show you exactly how this mistake is bleeding your portfolio dry, I need you to do something. Hit that subscribe button right now. This channel exists to tell you the truth about money that your broker won't tell you, that the financial media won't tell you, and frankly, that most people don't want to hear. We're building a community of serious wealth protectors here, people who understand that at our age, we can't afford amateur mistakes. Drop a comment below telling me the last time fear made you sell something you shouldn't. T-Happy, be honest, because what I'm about to share might save your retirement. Here's what's happening right now that should concern every single one of you. The Federal Reserve just cut interest rates to 3.5 to 3.75%. Inflation is cooled to 2.7%. The S&P 500 just hit record highs. And you know what millions of Americans our age are doing? They're sitting on the sidelines in cash, paralyzed by fear, watching their purchasing power erode while the market climbs without them, or worse. They're making emotional decisions every time. The market hiccups, they sell when things look scary, they buy when things look safe. They do the exact opposite of what builds wealth, and they do it over and over and over again. According to Dalbar's latest research, the average equity investor has underperformed the S&P 500 by nearly 4 percentage points annually over the past 30 years. That's not because they pick bad stocks, it's because they let their emotions dictate their decisions. They panic sold during downturns and bought back in after recoveries were already underway. Let me put that in terms that matter to you. If you had $500,000 saved 20 years ago and just left it in an S&P 500 index fund, you'd have approximately $3.2 million today. But the average investor, they turned that same $500,000 into roughly $1.4 million. That's $1.8 million left on the table. Gone. Evaporated. Not because of market conditions, because of emotional decisions. At our age, we can't afford this kind of self-inflicted wound. That's not building wealth. That's transferring wealth from your pocket to someone else's pocket. Someone who kept their head while you lost yours. Before we get into specifics, you need to understand something I've learned over 4 decades in the markets. There are 2 types of investors in this world. Those who control their emotions and let their money compound in peace. And those who let their emotions control them and wonder why their portfolios never seem to grow despite decades of saving. It's that simple, and it's that brutal. Wealthy investors, the ones who actually build generational fortunes, they understand that markets fluctuate. They understand that volatility is the price of admission for long-term returns. They don't celebrate when markets are up, and they don't panic when markets are down. They have a plan and they stick to it, regardless of what the headlines say. Warren Buffett, who at 93 years old is still one of the greatest investors alive, said it best. Happy is fearful when others are greedy, and greedy when others are fearful. That one sentence contains more investment wisdom than 1,000 hours of financial television. And yet, most investors do the exact opposite. They buy when everyone else is buying. They sell when everyone else is selling. They let the crowd dictate their financial future. Which type of investor do you want to be? Because you can't be both. And the decisions you make in the next 5 to 10 years will determine whether you retire with dignity or spend your final decades worrying about money. Now, let's look at the 6 emotional mistakes that are destroying retirement portfolios right now. And I want you to listen carefully because I guarantee at least 3 of these apply to you. First mistake keeping you poor is panic selling during market dips. This one makes me furious because I've watched intelligent, successful people throw away decades of gains in a single afternoon of fear. Here's what happens. The market drops 5%. The financial news starts screaming about crashes and corrections. Your portfolio is down $50,000 on paper, and your gut tells you to sell everything before it gets worse. So you move to cash, you feel relieved, and then the market recovers, as it always does, and you're left on the sidelines trying to figure out when to get back in. Let me hit you with the math that matters. If you had invested $100,000 in the S&P 500 in January 2008, right before the worst financial crisis since the Great Depression, and you held through the entire collapse, you'd have approximately $580,000 today. But if you panic sold at the bottom in March 2009 and waited until the market recovered to its previous high before buying back in, you'd have roughly $320,000. That's $260,000 lost. Not to the market, to your own emotions. At our age, we don't have 20 years to make up for that mistake. I know this one personally. I've seen friends our age sell at the worst possible moment because they couldn't stomach seeing their account balance drop. They thought they were being smart. They thought they were protecting themselves. What they were actually doing was locking in losses and missing the recovery. Here's your fix. Before any market correction happens, write down your investment plan. Include specific circumstances under which you would and would not sell. Then tape it to your computer monitor. When fear hits, read it out loud before making any trades. Second mistake destroying portfolios is checking your accounts too often. And this one is especially dangerous for those of us who are retired or approaching retirement because we have more time on our hands. I've seen people check their portfolio 3, 4, 5 times a day. Every notification from their brokerage app sends the heart racing. Every uptick brings joy. Every downtick brings anxiety. This is not investing. This is gambling addiction dressed up in a suit. Research from Vanguard shows that investors who check their accounts daily are significantly more likely to make emotional trades than those who check monthly or quarterly. The more you look, the more you react. The more you react, the more you trade. The more you trade, the worse your returns. Here's the thing about retirement portfolios. They're supposed to compound over years and decades, not hours and days. When you check constantly, you're exposing yourself to noise that has no bearing on your long-term financial outcome. A daily swing of 2% means nothing to someone with a 20-year time horizon. But when you see it in real time, it feels catastrophic. I check my portfolio once a quarter. That's it. 4 times a year, and you know what? My blood pressure is lower, my sleep is better, and my returns are higher than when I used to watch every tick. Here's your fix. Delete the brokerage app from your phone. Set up automatic monthly statements to come by mail. If something truly catastrophic happens, you'll hear about it. Otherwise, let your money work in peace. Third mistake, bleeding your retirement dry, is following financial media too closely. This one makes me angry because I've been on financial television for years and I can tell you exactly how it works. The financial media needs eyeballs to sell advertising. Fear generates eyeballs. Every day, they need a new crisis, a new warning, a new reason for you to stay glued to the screen. The Federal Reserve might do something. Inflation could spike. China, tensions are escalating. Tech stocks look overvalued. There's always something to worry about. Always. And if you let these headlines drive your investment decisions, you'll be trading constantly, chasing every new concern, and underperforming the market every single year. For those of us who remember the coverage during 2008 and the dot-com crash, you know exactly what I'm talking about. The media was predicting the end of capitalism. They were telling people to sell everything, and those who listened are still trying to recover. Those who ignored it and held their positions are wealthy today, the anchors on those shows, including me, are paid to fill airtime. The guests are there to promote their products. Nobody on television is personally responsible for your retirement, only you are. Here's your fix. Limit your financial news consumption to 1 hour per week maximum. Read one quality publication on Sunday afternoon, then turn it off and live your life. Fourth mistake that's quietly draining your wealth is chasing yesterday's winners. And I see people our age do this constantly because it feels safe to buy what's already going up. Here's how it works. You see the tech stocks are up 40% this year, or gold just had a massive run, or some sector is dominating the headlines. So you move money into that sector, expecting the gains to continue. What you've actually done is bought high, which is the first half of the classic wealth destroying formula. Markets are cyclical. What outperformed last year often underperforms next year. That's not opinion. That's decades of historical data. And when you chase past performance, you're almost guaranteed to be buying at or near the top, according to research from Morningstar. The average investor in the best performing mutual funds over any 5-year period actually earned less than the fund itself returned. How is that possible? Because they bought after the gains and sold after the losses. They consistently showed up late to the party and left early. And for those of us who've been investing for decades, we should know better. We've seen this pattern before. The dot-com darlings of 1999 became the disasters of 2000s. The real estate investments that seemed unbeatable in 2006 collapsed in 2008. Chasing heat is a young person's mistake. We don't have time for it. Here's your fix. Before buying any investment, ask yourself one question. Am I buying this because of solid fundamentals and fit with my overall strategy, or am I buying it because it's gone up recently? If it's the latter, walk away. Fifth mistake that will destroy your retirement is trying to time the market instead of spending time in the market. Let me be very clear about this, because I've heard every version of this mistake over my 40 years of investing, waiting for the market to drop before buying, trying to get out before the next crash, sitting in cash until things feel safer. Here's what the data actually shows. Missing just the 10 best days in the market over the past 30 years would have cut your returns by more than half. Not the best years, the best days. Those days almost always come during periods of extreme volatility and fear. The days when you wanted to sell. The days when you were certain things would get worse. If you're trying to time the market, you have to be right twice: when to get out and when to get back in. Professional fund managers with armies of analysts and billions of dollars in resources can't do this consistently. What makes you think you can? I've seen people sit in cash for 3, 4, 5 years, waiting for the perfect entry point. While they waited, the market doubled, then tripled, and they're still waiting, now paralyzed because they can't bring themselves to buy at all-time highs. At our age, time is the one resource we can't replace. Every year you spend on the sidelines is a year of potential, compounding lost forever. The median retirement savings for Americans 55 to 64 is just $185,000. That's not enough to retire on. And yet many of these same people are sitting in cash waiting for the perfect moment that will never come. Here's your fix. If you have money to invest, put it to work systematically, dollar cost average into your positions over 6 to 12 months. If you're nervous, but get in the market and stay in the market. Sixth and final emotional mistake. Destroying portfolios is letting fear keep you too conservative for too long. And this one is specifically dangerous for people our age because it feels like the responsible thing to do. Here's the conventional wisdom that's actually destroying retirements. You're 60 years old. You should be mostly in bonds. You're retiring soon. You need to be conservative. You can't afford to lose money. But here's what that conventional wisdom ignores. You might live another 30 years. Inflation at just 3% will cut your purchasing power in half, over 24 years. Those safe bonds yielding 4% aren't keeping pace with the real cost of retirement, especially healthcare, which is increasing faster than general inflation. Medicare Part B premiums alone went from $174.70 to $185 this year, and they're projected to keep rising. Your Social Security COLA of 2.5% doesn't come close to covering the actual increase in retirement expenses if your portfolio isn't growing. It's shrinking in real terms, period. And I'm not saying you should be 100% in stocks at 65. That would be reckless. But I'm saying that having zero growth exposure because you're afraid of volatility is equally reckless. It's just a slower way to run out of money. Warren Buffett has a significant portion of Berkshire's assets in equities. He's 93 years old. He understands that you need growth to outpace inflation regardless of your age. Here's your fix. Work with a qualified advisor to determine an age-appropriate allocation that includes growth assets. For most people our age, that means some equity exposure, even if it's less than what you had at 40. Let me tell you about two people I know. Both were 60 years old in early 2022. Both had worked hard for decades and saved diligently. Both had approximately $800,000 in their retirement accounts. When the market dropped over 20% that year, the first person panicked. He moved everything to cash in October 2022, right near the bottom. He said he'd wait until things settled down to get back in. 2 years later, he's still in cash. His $800,000 is now worth about $780,000 after inflation. He's working 3 days a week at a consulting job he doesn't enjoy because he doesn't feel like he can afford to fully retire. The second person did nothing. She didn't check her accounts obsessively. She didn't watch the financial news. She had a diversified portfolio and she stuck to her plan. Her $800,000 dropped to about $640,000 at the worst point. She felt sick. She couldn't sleep some nights, but she didn't sell. By the end of 2024, her portfolio had recovered to over $950,000. She retired last spring. She travels, she spends time with her grandchildren, she has peace of mind, same starting point. Same market conditions, different decisions, different retirements. It's not too late for you to be the second person, but the window is closing. Every emotional mistake you make from here costs you more than it would have at 40 because you have less time to recover. So let me bring this all together for you because at this stage of life, these aren't optional. Stop panic selling during market dips. Stop checking your portfolio obsessively. Stop letting financial media drive your decisions. Stop chasing last year's winners. Stop trying to time the market. And stop letting fear keep you too conservative for too long. These 6 mistakes are the difference between retiring with dignity and working until you're 75 because you can't afford not to. It's not about your salary. It's not about how much you've saved. It's about the decisions you make with what you have. Here's exactly what I want you to do this week to protect what you've built. Day 1, write down your investment policy statement. What's your target allocation? Under what specific circumstances would you buy or sell? This document will save you from yourself when emotions run high. Day 2, delete all brokerage apps from your phone and set up quarterly paper statements. You don't need minute-by-minute access to your life savings. Day 3, unsubscribe from all market newsletters except one. Limit financial news to 1 hour per week maximum. Day 4, review your current allocation and ask yourself honestly if you're letting fear keep you too conservative. If you're sitting in more than 30% cash or cash equivalents, you need to have a serious conversation with an advisor. Day 5, set up automatic investments if you're still working, or automatic rebalancing if you're retired. Take emotions out of the equation entirely. Day 6, call your financial advisor and schedule an annual review specifically to discuss your emotional relationship with money. If you don't have an advisor, this is the week to find one. Day 7, come back to this video and watch it again. Repeat as needed. Will you protect what you built, or will you let emotion destroy everything you've worked for? Your grandchildren are watching. Your legacy is being written right now. If this video opened your eyes to what's really threatening your retirement, I need you to take action. Smash that like button. Tell the algorithm that content for serious investors like us matters. Leave a comment below and make a commitment. Tell me one specific change you're going to make this week. When you write it down publicly, you're far more likely to follow through. And if you haven't subscribed yet, what are you waiting for? This channel is for people who understand that protecting wealth is just as important as building it. Hit subscribe, turn on notifications. Become a member if you're serious about your financial future, because I'm going to keep bringing you the strategies and the hard truths that actually work. The market doesn't care about your feelings. It doesn't care about your excuses. It only rewards those who can control their emotions and stick to their plan. Be one of those people. Now get out there and make it happen.